Reason number 5, inflation isn't going away. CPI continues to go up. CPI is the Consumer Price Index, as you can see here. It's a flawed government measure of how average consumer prices go up, and you can see where it's exploded. Another measure, not quite as popular, is the Producer Price Index. The Producer Price Index tracks the cost of the inputs for the producers to produce those consumer goods. As you can see, it continues to grow unabated. We look for more interruptions in the supply chain, specifically from China, that produces most of the world's goods in the modern economy. The reason that we look for a continued sporadic interruption in the supply chain of China is a combination of factors. The first is that China primarily uses the Sinovac vaccination, which, as you can see in this Economist chart, is not very effective against Delta for preventing infection. And in this NPR article, we can see where Hong Kong University has a study that's not yet published that found that this Sinovac vaccine does not generate enough antibodies to protect against Omicron, even with a booster shot. So we know that China has weak protection from Delta and Omicron. We know that they're highly communicable diseases. And we also know that China has a zero tolerance policy for COVID infections. They simply shut down and quarantine any cities or provinces that have known COVID infections. We've seen it go on multiple times in 2021, and most recently here on December 14th, according to this article, that it happened again, and it happened in one of the most productive provinces in China. So we know there's going to be upward price pressures on producers through PPI. We know there's going to be some more supply chain disruptions coming from China. Simply put, inflation isn't going away very quickly in 2022. Reason number 4, the Federal Reserve is going to hike its interest rates. According to it, it's going to hike its interest rates multiple times in 2022, and the stock market believes that it's going to be about 3 times in 2022. Looking at this chart from Fed, which is the Federal Reserve Bank in St. Louis, we can see the federal funds rate. This is the rate that's going to get hiked on the green line, and we can see recessions on the gray line. So you can see where the Fed cuts down interest rates going into a recession. Now they've got to raise them before they can cut them back down, which is why you see the raise and then the plateau, or the peak as the case may be, before those rates get chopped, trying to bring us out of recession. And so you can see in 91, in 2001, and 2008 where these recessions came about, and either the rate was going down or was chopped significantly. But in all those cases beforehand, it was raised up. And you can see in 2016 where it was raised up and then lowered again before 2020. So they're going to start raising rates here in 2022. And at some point after that, that's going to bring about a recession. Reason number 3, margin debt for investors is at all-time highs. This is a great chart from the advisor perspective, and it shows the stock market in blue for the S&P 500 monthly closes, and then in red or green as the case may be, you can see the net balance for these margin account. Margin is when you borrow money to trade, and the amount of debt you've borrowed is what's outstanding, and when you have a margin call, you've got to repay that debt. And so what's important here is that when you borrow money for that margin, you pay interest on it. And the higher the interest rate, the less you're going to be able to service that debt. The more you've got to pay a higher interest rate, the more debt you've got to wind back in. So we just talked about how the Federal Reserve is going to raise its base rate 3 times in 2022. Now let's compare that with the margin debt that exists in the market. The market has some of the highest levels of margin debt we've ever seen. When the Fed raises the interest rates, it's going to force some of that margin debt, along with other debt, to be dialed in as the interest rate continues to go up. Reason number 2, the Fed has started tapering their quantitative easing program. Quantitative easing is where the Federal Reserve Bank goes and buys treasuries and mortgage-backed securities. These are long-term loans, 20 to 30 years minimum, and they bought those to provide liquidity in the market for COVID. What happens is that when you purchase an investment, that investment's return on investment, that ROI, is measured in alpha, and the risk is measured in beta. And treasuries usually have the lowest alpha and beta coefficients of any investment. This means that they are the safest and lowest returns. When the Federal Reserve went and bought these treasuries and mortgage-backed securities, what happened is they built in profits for the banks they were buying them from, and they displaced conservative investors, the most conservative investors, out of those treasury and mortgage-backed securities markets. And so not only has the Fed begun the tapering, but the Fed has announced that they're going to taper faster. Now, to be clear, the taper means they're going to buy less. It doesn't mean they're going to stop buying. But if you buy less over time, you're eventually going to trend towards stop buying. And when you stop buying these T-bills and these mortgage-backed securities, the investors that have been displaced, that have been forced to go to the market in equities markets, such as the stock market, they will slightly return, which means that they'll pull money out of the market. So now we've got a perfect storm. We've got a situation where the market is going to see an increase in interest rates on debt when margin debt is the highest. At the same time, we're going to see people pull out of the market, causing the value of the underlying assets for the margin debt to drop, which is going to cause margin calls, which those three things together should lead to a sell-off in the stock market. And as the economy slows down, we should see a recession. And finally, the number one reason we are likely to see a recession in 2022 is that stocks are overpriced. Here's a great write-up from Advisor Perspectives. I'm not associated with them, but here's a great write-up with them about it. You can see the average trend line for the S&P composite. You can see that is highly above the average. You can also see that in the last 10 years, it has shot up dramatically. That means that the PE is 100, and the PE ratio, which is the price to earnings ratio, basically how much are you overpaying for a stock, is 198% above its average. Continuing on, we have another interesting chart here which shows a correlation between that PE ratio and inflation. And we can see this correlation is the highest ever. If you look at the yellow dot, that's where we're at now with really high inflation and really high PE ratios. Compare this to the tech bubble from February of 1998 to August 2001, and you will see several dots because that's over a 3-year period, but inflation was nowhere near as high and the PE ratio was nowhere near as high. Now you can also see from 2014 to present in the purple and how we've built up to where we're at now. So we've never seen stocks be this overpriced and inflation be this expensive. Even going back until the Great Depression, if you look in August and September of 1929, we didn't have the inflation that we have today, and the PE ratio, the price to earnings ratio, wasn't this high. We should see a recession in about the next 12 to 18 months. I think it'll happen in 2022. Tell me your thoughts below about what's going to happen in the economic circus.